Why long TLT if the Fed will need to keep interest rates above 5% into 2024 to succeed in taming inflation back to 2%? If you are long TLT today, your thesis is basically expecting a recession as soon as possible, so that the Fed will drop the interest rate back to 0%. At that time, based on how serious the recession gets, the price of TLT will go up to 170 to 190 level. Of course, you can get 4% yield every month in the meantime. However, what if the Fed doesn't drop the interest rate back to 0%? What if they only drop to 2%? As that's their primary goal, to lower inflation back down to 2%. What is the final price level you can get for TLT at 2%? What about 3%? The Fed might change the goal to 3% from 2%. Will they do that? What's the price level of TLT if the rate's back to 3%? Is it still worth long TLT in that case? Let me explain. And of course, smash the like button. If you want to be my good boy, apply to write your first book with me. Welcome back to the Audacious Money Witch channel, where we talk about macroeconomy, stocks, bonds, and commodity markets. If you like any of these topics, you are intelligent. That's why you're here, and you know what to do. And push my button if you like what you see in today's video, because I can't push it from this side. This video is brought to you by my Patreon. If you are a good boy, go to patreon.com/magicalgoddesscheryl to add more meaning into your life. If you play your cards right and completely submit like my good boys do, then I will take you under my wing, author of best-selling books, Goddess Cheryl. My good boys always get rewarded handsomely. You are such a good boy. You like hearing that, don't you? You want it to be real. You want it to be true. You need to be my client, don't you? The Fed will likely need to keep its benchmark policy rate north of 5% for most of 2023 and into 2024 to succeed in taming inflation, said St. Louis Fed President James Bullard. I think we'll have to stay there all during 2023 and into 2024. Bullard was responding to a question about how long he expects the Fed funds rate will need to remain in the 5% to 7% range. It seems markets are still underestimating the degree to which the Fed will need to keep policy tight in order to rein in inflation, explaining that there is still some expectation that inflation might subside on its own. A few weeks ago, Bullard caused a stir and provoked a brief sell-off in U.S. stocks when he suggested during a presentation that the Fed funds rate might need to move as high as 7%. The Fed has already hiked the Fed funds rate by almost 400 basis points since the start of 2022. Presently, the upper bound of the Fed funds rate target is 4%. Stocks have advanced over the past month as investors celebrated softer than expected inflation in October. However, Bullard thinks that inflation will be stickier than investors expect, and it will likely take a while before it returns to the Fed's 2% target. They will come down, I think. That's my baseline. But they probably won't come down as fast as markets would like, he said. Investors have long paid close attention to commentary from the St. Louis Fed president. However, Bullard will no longer have a vote on the Fed's policy setting committee come next year. Asked about whether he would support a 75 basis point rate hike, at the Fed's December meeting. He said he would leave the exact tactics up to Jay Powell. In macroeconomic terms, I'm not sure it matters that much at exactly which date we get there or what meeting we get there, he said, referring to the timing at which the Fed funds rate will reach its terminal rate, that is, its peak for this hiking cycle. Generally speaking, I have advocated that sooner is better, that you do want to get to that right level of the policy rate for the current data and the current situation. But I would defer to the chair as how he wants to play the tactics on this. Asked about whether the low unemployment rate is helping to drive inflation higher, he said he doesn't believe the link between inflation and a tight labor market is as strong today as it has been in decades past. I've tried to de-emphasize the links between inflation and the labor market. I don't think that the feedback from the strength of the labor market to inflation is nearly as strong as many people portray it, he said. However, the fact that the labor market and underlying economy are as strong as they have been does, in his view, give the Fed license to pursue a more aggressive approach. I do think that the fact that the labor market is so strong gives us license to pursue our disinflationary strategy now and try to get the inflation under control right now so we don't replay the 1970s, where the FOMC at that time took 15 years to get inflation under control, Bullard said. He also pointed out that the contraction in the U.S. economy seen during the first half of 2022 is interesting, and that the prevailing slow growth economy would continue to help the Fed to achieve its inflation goals. Finally, when asked if he thinks the Fed should consider adjusting its 2% inflation target, he believes this is a completely terrible idea for this environment, even as the inflation moves toward the Fed's target. He believes the central bank will need to maintain its aggressive stance until inflation has receded all the way to 2%, lest they risk easing up prematurely and risk allowing price pressures to spiral out of control. We do have to maintain downward pressure until it's clear that we're going to achieve 2%. The Fed shouldn't raise its inflation target. Some people are suggesting that the Federal Reserve considers a compromise in its battle with rising prices, instead of imposing the full monetary tightening required to get inflation back down to its 2% target. Why not increase the target a bit? The central bank last changed its inflation objective quite recently, in August 2020. Previously, the Fed had tried to hit the 2% target at all times, regardless of past performance. Under its revised monetary policy framework, it would seek to achieve an average of 2%. The new regime reflected the experience following the 2008 financial crisis, when inflation persistently ran below target, causing inflation expectations to fall. This increased the likelihood that the Fed's short-term interest rate target would get stuck at the zero lower bound, making it more difficult for the central bank to provide monetary stimulus, precisely what happened during 2020. Now the Fed faces a different problem. Inflation is too high. This has caused some prominent economists to ask, what's so special about a 2% inflation target in the first place? Why not 3% or even higher? A higher target would result in a higher peak in nominal interest rates during economic expansions. This would create more room to cut rates during downturns. reducing the risk of getting pinned at the zero lower bound and lessening the need to use other monetary policy tools such as quantitative easing and forward guidance. I find the case unconvincing for 5 reasons. First and most important, there's already less risk of being pinned at the zero lower bound, with short-term interest rates likely to peak at 5% or more this economic cycle. The Fed will have plenty of room to cut rates when the time comes. The 2 recent episodes of zero interest rates might even be outliers. Addressing climate change and building more resilient supply chains will require investment, while government deficits and retiring baby boomers will reduce savings, potentially increasing the neutral level of inflation-adjusted interest rates. Second, I believe the Fed has already subtly raised its inflation objective. When Chair Jerome Powell talks about getting inflation back to 2%, there's no mention of going below 2% to offset recent persistent overshoots. This is consistent with the view of former Chair Ben Bernanke. Compensating for undershoots keeps inflation expectations from falling too low. But compensating for overshoots increases the risk of getting stuck at the zero lower bound. This asymmetry will naturally lead to average inflation of more than 2% over time, something I suspect the Fed will someday codify as official policy. Third, a higher target could cause households and businesses to pay more attention to inflation in their investment and spending decisions, increasing economic friction and uncertainty. Alan Greenspan once defined price stability as that state in which expected changes in the general price level do not effectively alter business and household decisions. At 2%, the price level doubles every 35 years, a sufficiently long time horizon to be barely noticeable and to meet Greenspan's standard. With a higher target, there's a greater risk that inflation would distort economic behavior. Fourth, a higher inflation target could violate the Fed's congressional mandate. The 1978 Humphrey-Hawkins Act established 3 objectives: maximum sustainable employment, price stability, and moderate long-term interest rates. The Fed has stretched the definition of price stability to 2% average inflation. Going further would likely conflict with Congress's guidance, just as it conflicts with Greenspan's. Finally, moving to a higher target before the Fed gets inflation back to 2% would undercut the central bank's credibility. Moving the goalpost would be interpreted as a failure, making it more difficult to anchor expectations around the new objective. After all, if the Fed is willing to change the target once, why believe it won't change it again? All told, there's no easy way out. The Fed should keep its 2% inflation target, whatever the costs. The alternatives are worse. As for the TLT price target, if the rate is 3%, TLT will only go to 123. Quite low, I know. If 2% target achieved, TLT will be back to 148. If 0% is reached again, TLT will be at 180 to 190 range. 45% upside from here to 2% target. You have to decide if that's worth it for you. Okay, now I'm going to show you my client Lee Vinson's book, The 3 Most Important Influencers You Need to Meet. I did write the foreword in this book. And my client Teddy Eazzy's book, Wicked Pussy Perfume. It is an erotic novel. Such an amazing book. Such amazing books. You are such a good boy for watching my video right till the end. Bye.